And that brings us to the next topic, why OTC trading will continue, why it's not cease to exist, why not all trades will move to CCPs. So first, as I explained, or as I mentioned, there is a big liquidity risk, concentration risk. Clear trades have to pay initial and variation margins, require significant collateral, most often cash. They also receive 2% risk weight against CCP default. So there is extra charge, which I will mention also later, in the form of this 2% risk-weighted asset. Many CCPs don't have netting agreements between them. So if you have two offsetting trades going to different CCP, they attract, each of them basically attract collateral. But if you trade them OTC, then they will just net and no collateral will be needed. Similarly, while interest rate swaps are cleared, but many similar trades, plain vanilla trades like inflation derivatives are not, then any offsets between two books will be lost, and again, that will require much larger collateral pool because of this offsetting is lost. Finally, or large market segments of derivatives like swaptions, cross-currency swaps, many CDSs will likely remain non-cleared because of CCP's eligibility requirements. And some counterparty in some jurisdiction, as I mentioned before, will be exempted, like corporate, sovereign, and pension funds in European Union. So that means that many participants will have to calculate for some trades cost of CCPs, and for some trades cost of going over the counter. But there will be many cases when they will have option to clear or not to clear. So it's important to be able to compare this cost, to calculate them side by side, and choose the most effective way to optimize capital. So we talked now about clear trades, and now as the second part, I would like to talk about non-clear trades. And here, most famous kind of, probably the biggest capital charge is Basel III CCR capital charge. So we'll talk about it in details. But a little bit of history. Basel II, which a recommendation by Basel Committee finalized in June 2006. It's already included capital charges regarding provisions for counterparty default in the form of risk-weighted assets, RWA. We already saw this acronym before. But during financial crisis, many banks incurred losses due to CVA moves, not due to defaults. So Basel II, once again, it's capital charge against default. Now we see losses coming not from defaults, but from CVA moves. And the estimation is that only 1/3 of total bank losses came from defaults and 2/3 from CVA volatility. So Basel III, which was initially published in December 2010, but then finalized in June 2011, introduced new capital charge against CVA volatility. This can be calculated using either standardized or advanced formula. I will describe them on next slides. But it's not, there were some other CCR-related changes. For RWA, you have to calculate stressed exposure. You have to take into account general and specific wrong-way risk. You have to apply an extra multiplier of 125 due to systemic risk. You have to include in CSA extra margin period of risk, and finally applying risk weighting of 2% for central counterparties. So it's not only a new CVA charge, but Basel III also strengthened other counterparty CCR-related capital charges. Reflecting the fact that banks are actively hedging CVA positions, Basel III recognized credit hedges, single name CDSs, contingent CDSs, which actually not traded, and CDS indexes for alleviating CVA volatility. They don't recognize market hedges like interest rate swaps or volatility hedges, but that might change soon. And one interesting thing, we had like a separate webinar on this. Benefit of hedges differs between the standardized and advanced approaches. So depending on which approach you are using for calculating CVA VaR, you have, or CVA capital charge, you might use different hedging strategies. So this is the graph which basically explains CCR capital charges. They are all under Pillar 1 capital requirements that was introduced by Basel II. So you see RWA at the top, and this RWA, it has default risk, which is covered by RWA capital charges introduced in Basel II. But now in green we have a new additions of Basel III, and this is CVA capital charge, with the charge which alleviates the CVA volatility, and also, as I mentioned, wrongway risk. We talked also about LCR liquidity ratio. There is also leverage ratio and so on, also new in Basel III. But for now, we talk about counterparty credit charges.